90% of traders use indicators that died a decade ago. You feel the pain every time you blow an account. Cluttered charts, lagging signals, constant confusion. It's not your fault. The method is broken. You're set up to fail. You can have clean charts, confident entries, and 3 indicators that align with how markets move today. Clarity replaces confusion. What if everything you learned about RSI was a trap? Results not guaranteed, education only. Indicator 3 shocks even pros. Stick with me because by the end of this section you'll understand why your charts have been lying to you. The indicators you use, RSI, MACD, stochastic, were born in the 1970s and 80s. They were designed for a slower world. Phone calls, ticker tape, human pit traders. Markets moved at a crawl. You didn't have algorithms hunting liquidity in milliseconds. You didn't have machines front-running your every order. So why decades later does your broker still push these same default settings on you? Think about that. They give you a 1978 tool and tell you it's the key to modern profits. You feel the frustration. The setups look perfect, then the market moves against you in a heartbeat. It's not your fault. It's the time disconnect eating your edge. Today's market microstructure has been rewired by high-frequency trading and algorithmic dominance. Bots fight for sub-millisecond advantages. Your retail indicator, no matter how carefully tweaked, processes data that's already stale. By the time your RSI crosses 30, the machines have already priced in that oversold signal and reversed. You're trading on a lag you can't see. Using a 1980s indicator in today's market is like bringing a paper map to a Formula One race. You're navigating with static lines while the track changes at 200 miles per hour. But here's what nobody tells you about why these still, sometimes work. It's not because they predict. It's because you're caught in a loop of confirmation and survivorship bias. You remember the wins and forget the losses. You spot a textbook RSI divergence, take the trade, and it works. You feel smart. But the 10 times it failed, you rationalize. I misread the trend. The news moved it. You're not seeing the indicator's edge. You're seeing your brain's pattern-seeking addiction. The indicators themselves aren't predicting price. They're confirming what has already happened, giving you a comforting illusion of certainty. Lagging, repainting, overcrowded. That's the problem. You're reacting to a ghost of price action while the real move is long gone. There's one specific reason crowded indicators destroy your edge, and I'll reveal it next. It's the silent edge killer no one talks about. When every trader stares at the same RSI 14 oversold signal, the market adapts. The edge becomes a crowded trade. Algos and institutions know exactly where the retail stops and entries cluster. They exploit that liquidity, triggering your signal, then reversing to trap you. That oversold bounce you're waiting for, it's been gamed. The edge gets arbitraged away until it's just a lure. But here's the twist. The indicators themselves aren't broken. The way 90% of people use them is. You're applying a 1980s lens to a modern ecosystem, alone, with no context. The tool isn't the enemy. Your blind default application of it is. You need to stop asking, does this indicator work? And start asking, under what conditions does it still have an edge? This first one is used by institutions every single day, and most retail traders ignore it. You've been taught to chase breakouts or trust lagging moving averages, while the real money anchors to volume-weighted average price. VWAP doesn't just track price, it weights every tick by the volume behind it. Imagine a line that shifts only when big money commits. You've taken losses wondering why a level held. It's because VWAP was there, invisible to you. Stillness creates clarity. Clarity creates memory. Memory creates discipline. When you anchor to VWAP, you anchor to where capital actually flows. But there's a way to use VWAP most people have never seen: anchored VWAP. Instead of resetting daily, you attach it to a key event. An earnings report, a swing high, a breakout. Now you're seeing the average price institutions paid since that event. Institutions buy below it, sell above it. Simple. Picture a stock gapping up on earnings. Plot anchored VWAP from that close. Every retest back to that line becomes a test of true conviction. If price finds support there, the smart money is defending their position. Your entry is at the retest. Stop just below, target the prior range, a clean, repeatable setup. You stop chasing and start waiting. Pair this with the next indicator and your win rate context changes completely. But first, avoid common mistakes. Using VWAP on a 5-second chart where noise overwhelms signal, or ignoring volume context. A VWAP hold on declining volume is a trap, not confirmation. Vary your lens. VWAP works best on 15-minute to daily frames where institutional footprints are clear. This is not investment advice, it's a discipline tool. Stillness creates clarity. When you master VWAP, you trade less and see more. You stop reacting to every candle and start reading the market's true magnetic field. It's not a magic line, it's a mirror for actual equity positioning. Indicator 2 fixes the biggest weakness of traditional momentum tools. It shows you when momentum is genuinely diverging before price breaks. But momentum without volume context is just noise. VWAP gave you the map of institutional value. The next tool gives you the timing. You felt the frustration of seeing a trend reverse right after you enter. That's because you didn't see the exhaustion. VWAP is the gravity. The next indicator is the tilt. Together, they transform reaction into anticipation. Stay with me. In the next section, you'll see how to pinpoint entries with a precision you've never experienced. This indicator isn't about adding another line to your chart. It's about reading the market's intention before a single candle closes. You stop reacting to what price did and start anticipating where it's likely to go. Market structure is the simple observation of higher highs, higher lows in an uptrend and lower lows, lower highs in a downtrend. But here's the twist. This isn't really an indicator at all, and that's exactly why it works. You're not following a lagging formula. You're watching the raw rhythm of buyers and sellers, seeing the story unfold in real time. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You've been burned by false signals before, but that wasn't your fault. It was the method, not the trader. Now let's talk about the real predator. The market hunts liquidity. Every stop loss, every pile of breakout orders, those are the watering holes where sharp moves get funded. You picture a lion stalking its prey, patient and precise. Price will often drive into a zone of obvious support, break it just long enough to trigger stops, then reverse violently. It's not random. It's the liquidity grab. You learn to see the trap before you become the bait. The market needs your order to fill the other side. So what if every painful fakeout you ever suffered was actually predictable? It wasn't the market cheating, it was you standing in the wrong herd. Stillness creates clarity, and once you see the footprint of hunted stops, anticipation becomes your edge. Here's a practical walkthrough. Price makes a higher high, then breaks below a key higher low, a break of structure. You don't panic. You wait for the retest. That break is often a liquidity sweep, and the old support becomes new resistance. When price returns to that level and stalls, you take your entry with a tight stop just above. It's that simple and that hard. So stop chasing candles. Start reading intent. The candle itself is just a shadow. The real body is the liquidity imbalance behind it. You're not guessing momentum anymore. You're observing a chess move. This is the shift from retail guessing to professional anticipation. Stillness creates clarity. And discipline builds when you know the structure you're waiting for before it even forms. Now layer the VWAP from earlier. When that retest aligns with the volume-weighted average price, The confluence speaks volumes. The market structure tells you what, order flow tells you why, and VWAP tells you where the institutional mean reverts. Short sentences, clean lines, no clutter. You're training your eyes to see what's actually moving price, not what screams for attention on social media. Stillness creates clarity. Clarity becomes your freedom from impulse. But indicator number 3 is the one that surprises even professional traders. It's not a line, not a band. It's something so simple you've overlooked it 100 times. And that's exactly what we'll expose next. This last one is the filter that separates random trades from high-probability ones. You take a breakout, it rips, then evaporates. You're left holding a loss, questioning your timing. The chart looked perfect, but something was off. That something is often volume. You can't see participation on a price line alone. That's why pros use relative volume, RVOL. It compares current activity to the recent average. When it spikes above 1.5, someone is behind the move. Paired with ATR quantifying volatility, you filter out fakes. This is the one I promised would shock the pros. Here's why. Instead of reacting to every twitch, you wait for the volume to confirm. Volume confirms intent. Without it, a breakout is just hope. Hope is not a strategy. You'll start seeing real opportunity. Immediately, you'll feel the shift in your trading clarity now. Now pair RVOL with ATR, average true range. ATR isn't a direction tool. It quantifies the environment's liveliness. You set a stop or target based on a fixed pip number. That's gambling. When volatility expands, your stops need room to breathe. When it contracts, you tighten expectations. ATR shows you the market's current range, telling you exactly how far price might travel. You stop using arbitrary levels and start using data. Suddenly, your stop isn't picked off by random noise. Your target isn't an unrealistic dream. You align with what the market is actually offering. The best traders don't trade more. They trade only when conditions align. That's the quiet discipline that builds consistency. You stop fighting. You start flowing. The market becomes a map of probabilities, not a battlefield. That shift makes all the difference. It's discipline, not luck. Now you bring it all together. VWAP, structure, and RVOL. VWAP anchors the session's fair value. Structure identifies the market's posture, higher highs, lower lows. RVOL confirms genuine participation. When these three align, something powerful happens. You're no longer guessing. You see a pullback to VWAP after a structural shift with RVOL surging above 1.5. That's the entry pros wait for. Everything else is noise. This three-part filter eliminates the false signals that have cost you months of progress. It forces patience. Stillness creates clarity. Clarity creates memory. Memory creates discipline. The setup appears and you already know the answer. No second guessing. No revenge trading. Just a clean, high-probability decision. When all three align, you don't need to force anything. The trade presents itself. That's the edge most will never find. It requires stillness, not force. Quiet and the market speaks. The system is now complete. VWAP for fair value, structure for trend context, and RVOL with ATR to filter conviction and volatility. Clean charts. No distraction. You commit to this and you'll notice something. Your losing streaks shrink because you're no longer forcing setups. This is not investment advice. Trading involves risk. Only trade what you can afford to lose. But the discipline itself is worth the effort. If you're ready to commit to clean charts, type trading in the comments below. Make it your accountability statement. I read every one. Like this video if it brought you clarity, and subscribe for more psychology-first trading breakdowns. Check the description for a free community where we refine these skills together. Keep your charts clean, your mind still, and your edge sharp. See you in the next one. Stay centered. Trade well. You now have the framework. Bias, location, confirmation, 3 clicks, 1 safe. But here's the truth. A system is just a mirror. It reflects your mental state. Without the right mindset, you'll override the signals at the worst possible moment. You'll chase, you'll hesitate, you'll break your own rules. The sequence won't save you from yourself. That's the hard part. So what's the missing piece? The shift from knowing to doing, from seeking to waiting, from chaos to calm. Stillness creates clarity. Clarity creates memory. Memory creates discipline. None of this works without one mental shift, the one that turns this system from words on a screen into profit in your account. That shift is what we cover next. Ready for the final piece? It's simpler than you think, but it requires the one thing most traders refuse. The indicators are only 20% of the game. This next part, psychology, is the other 80%. You still reach for the same moving averages because they feel familiar. You've poured years into learning them. Relearning feels like admitting defeat. Fear of starting over keeps you anchored to tools that stopped serving you long ago. But why do you keep using what doesn't work? Your brain doesn't want the truth. It wants to be right. You force the indicator to confirm the trade you already decided to take. That's confirmation bias, and it's lethal. You tweak the settings until they match your bias, then blame the tool when it fails. There's a psychological trap that keeps 90% of traders stuck forever. The need to predict, not process. You're addicted to being right, not to being profitable. Overtrading is a dopamine loop. Each signal triggers a small hit, whether it's a winner or loser. You chase the next flicker, the next alert, convincing yourself you're being productive. But volume doesn't equal edge. Discipline beats prediction. Every time, you don't need more signals. You need the courage to sit still and let mediocre setups pass. Stillness creates clarity. Clarity creates memory. Memory creates discipline. That stillness requires emotional control. You can't wait for confluence when your nervous system is screaming for action. The best indicator you own isn't on your chart, it's between your ears. Master that internal signal first. When you stop obsessing over the outcome of a single trade and start respecting the process, the results become a byproduct, not a target. Log every decision. Review your detachment, not just your. Avoid these mistakes and you're already ahead of most traders. The first edge killer is indicator overload. You open your screen and it looks like a Christmas tree. Moving averages, Bollinger Bands, MACD, RSI, and 3 custom scripts all screaming different signals. You sit there paralyzed, watching the perfect setup drift away because you couldn't see through the noise. Clutter doesn't create clarity, it creates hesitation. Stillness creates clarity. Clarity creates memory. Memory creates discipline. And without discipline, you'll always chase. So ask yourself honestly, how many indicators are actually on your screen right now? Then there's the mistake of ignoring higher time frames. You get a clean entry on the 5-minute chart, and you jump in proud, only to realize you're fighting a massive daily resistance level you never bothered to check. The structure you ignored is now the wall that stops you out. Trading without that context is like reading one sentence of a book and guessing the ending. It feels clever, but it's reckless. You need to zoom out. Stillness on the higher time frame reveals the real intent of price. But the deadliest mistake is one you won't even notice at first. Curve fitting. You spend hours tweaking a strategy on historical data until the equity curve looks perfect. You adjust the RSI period, the moving average length, the ATR multiplier, every variable until it hugs every past pivot. It feels like mastery. It's really just memorization. You've built a fragile machine that only knows the past, backtested perfection, live disaster, sound familiar. When the market shifts, your over-optimized system crumbles because it was never robust. You must accept that no perfect backtest survives contact with tomorrow. True edge requires room to breathe. Stillness in your method beats a sculpted illusion. Another mistake is trading without volume confirmation. You see a breakout on price alone and you commit, but the move has no fuel. Without rising relative volume, that breakout is often a trap. Volume tells you who's actually fighting. If there's no one behind the candle, you're walking into thin air. Stillness waits for the crowd to prove interest. But here's the twist. The biggest mistake isn't technical at all. It's emotional revenge trading. That loss you just took starts a revenge loop. You jump back in, fists clenched, trying to get even. That's when your edge dies completely. You've got the system. You understand the logic. But let's be honest, knowledge without practice is just entertainment. Without a roadmap, you'll just be another person who knows the theory but can't execute it when real money is on the line. You need to turn this information into reflex. This isn't a sprint to a finish line. It's a deliberate process of neurological rewiring. For the next 14 days, your single, non-negotiable task is not to get rich. Your task is to print and collect data. You are a scientist, and your only goal is to prove the method works, one piece of historical evidence at a time. So let's strip away the noise and give you the exact practice protocol that separates someone who just watches videos from someone who actually transforms their trading. So here's a question. What actually separates a trader who improves from one who just repeats the same painful mistakes over and over? It's not intelligence. It's the feedback loop. The one who fails sees a losing trade and says, "The market is rigged." The one who improves sees a losing trade and immediately asks, "Did I force this setup? Or was it a perfect execution of a low-probability event according to my own rules?" This distinction is everything. After you've logged 50 backtests, a shift occurs. You stop seeing candles and start seeing the architecture of the trap. You predict the stop hunt instead of falling for it. This is where we transition from a dusty history lesson to the live, volatile present, using a demo account. Now, let's burn a deeply flawed idea, that you build consistency by sizing up. You build consistency by shrinking down until your execution is boring. When that tiny live account that you've risked 0.5% on has a perfectly flat equity curve for 4 weeks, you haven't failed to make money. You've succeeded in building discipline. You are testing your ability to withstand a loss without twitching, not your ability to score a lucky grand. This requires an agreement with yourself that speed of wealth is not the goal. Here's the twist: speed isn't the goal. Repetition under pressure is. Which is why I want you to commit to the 100 trade challenge. This isn't about profit, it's about pattern recognition. You will take exactly 100 setups based strictly on the system. No exceptions. Every single trade goes in the journal. By trade 70, you won't hesitate. By trade 90, you'll see a trap setting up 10 candles before it snaps. Fulfilling this contract with yourself rewires your identity from someone trying to trade into a disciplined trader. Remember, trading is a marathon. Past performance does not guarantee future results, and this education is not financial advice. You must accept the risk of loss. Let me bring it all together for you. You take a brutal loss and assume you misread the market. Wrong. You just misread the noise. It's not your fault. You traded a paper map for a GPS. The destination is the same, but the precision is lethal. But now you have to actually drive. A clean chart doesn't click the button for you. Seeing the setup isn't the same as taking it. Execution is the bridge between knowledge and profit. But there's one final, critical thing that determines if this works when your money is live on the line. It's the silent killer that turns a perfect backtest into a blown account. It's bigger than the indicators. Full disclosure, trading is hard. The content you consume here is strictly for educational purposes, not financial advice. I am not telling you what trade to take or promising you a dime. Results are never guaranteed. You are responsible for your own risk management. Never trade money you can't afford to lose. A system doesn't fix a gambler. If you're out of control, no VWAP code will save you. Trading is your commitment. Comment it below. Lock in your intent publicly. This isn't just a comment, it's an accountability marker. Hit like to anchor the lesson. Subscribe so systemic discipline replaces random consumption. Right now, check the description for the community link where we build consistency together. Stop trading alone. Your only competition is your old patterns. See you in the next setup.